You just clicked submit. Somewhere, a system just made a decision about you in under 3 seconds.
Not a person, what a machine. And what it just did with your data is something almost nobody outside a bank ever sees.
I spent 14 years inside that system. Today, I'm going to show you exactly what happens in those 3 seconds.
The moment you hit submit, your application data starts moving through parallel systems, not one at a time. First stop, a credit bureau pull. Most issuers pull from one of the 3 major bureaus, and which one they use isn't random. Banks pick bureaus based on regional data quality and existing relationships, and even which bureau tends to score their specific applicant pool more favorably. At the exact same time, a separate fraud and identity verification engine is running. It's checking whether your name, address, social security number, and device fingerprint all match known patterns. It's comparing your application against databases of known fraud rings, synthetic identities, and prior charge-offs. This isn't a sequential case. It's happening in parallel with the credit pull, which is part of why the whole thing resolves in seconds, not minutes. Here's the part almost nobody explains. Some applications get killed right here, before any human, or even the core underwriting model, ever sees the file. If the fraud engine flags a hard mismatch, or the identity verification fails outright, the application is dead on arrival. No appeal queue, no manual review. Now here's something that surprises almost everyone. The credit score you see in your banking app, your FICO or Vantage score desteeming, is not the number the bank actually decides on.
It's one input into a much longer internal scorecard that the issuer built themselves.
And that scorecard is not public. That internal model looks at dozens of variables the advertised score doesn't fully capture on its own. How fast your debt-to-income ratio has been moving. How many hard inquiries you've had in the last 6 months. How close you are to maxing out existing cards. And how your utilization has trended over the last few statement cycles. Hey month, not just where it sits today.
Let me give you a composite example, built from patterns I saw repeatedly, not any single real file.
2 applicants, same 720 credit score. Applicant A has had that score sitting flat for 2 years, low utilization, no new inquiries.
Applicant B, a young Asian woman, hit 720 last month after paying down a card.
But has 3 new inquiries and utilization that was over 80% 2 months ago. The other gets flagged, and I'll show you exactly why and what the outcome was in a future video. So where does an actual human being enter this process? Less often than you'd think.
The overwhelming majority of applications. Some issuers report well over 90%, but
flow straight through an automated decision engine. Approved or denied, or the applications that get pulled into manual review are the ones that don't cleanly fit the model. That usually means a borderline score sitting right at the edge of the approval threshold. Data that doesn't reconcile, like income that doesn't match what other data sources suggest. Or a requested credit limit that's unusually high relative to the applicant's profile. When a file lands on an underwriter's desk, they are not going on a gut feeling.
They're working from a checklist of specific, documented risk factors.
Verifying income against pay stubs or tax documents.
Checking for recent derogatory marks that the automated system flagged but didn't have enough weight to auto-deny on.
And confirming that the application details are internally consistent. It's methodical, not intuitive. The human layer exists to handle exceptions, not to replace the model.
Once a decision is made, you get one of three outcomes.
Full approval at the limit you requested. Approval at a lower limit. Or denial. That lower limit approval is more common than people realize, and it's not arbitrary. It usually means the model approved your risk profile, but capped your exposure based on your existing total credit lines.
A denial isn't just a no. By law, it has to come with an adverse action notice. And that notice has to disclose the specific reasons for the denial, in tubre, not vague language.
But the actual factors that weighed against you, pulled straight from the model or the bureau data.
Here's the practical tip almost nobody gives you. Timing your application around your credit report's reporting cycle matters more than most advice admits. If you know a card issuer is about to report a lower balance to the bureau, waiting even 2 to 3 weeks past a big payment, instead of applying immediately, can move a borderline utilization number into a range that clears an automated threshold. It's not about improving your habits. It's about applying when the data snapshot actually reflects them. Every one of these steps happens, whether you notice it or not.
Next time, I'll break down the exact reasons banks reject people with good credit scores. Something almost nobody explains correctly. 7 reasons banks reject good credit scores that no one tells you. Subscribe if you want to see how the system actually works.
Not how it's marketed to you.